Good morning, everyone. Welcome to this morning's webinar on insurance and the business continuity cycle. My name is Marcus Vaughan and I am your host today. And thank you very much for joining us. Today, we are in really good company. We're joined by Simon Peaty, who's our Regional Manager for Risk Logic in New South Wales and Queensland. Simon's got over 18 years experience in assisting people and clients prepare for and respond to crisis events. We're also joined with Roger Newsom, who's a Client Director and National Practice Leader for the Food and Beverage of Aon Risk Solutions in Sydney. Roger, again, has over 20 years experience in the insurance industry, again, preparing clients and people prepare for the worst. Good morning, gentlemen.
Morning.
Morning, Marcus.
Right, before we get started, just a little information about today's agenda and format. As you've seen, today's topic really is insurance and the business continuity cycle. We're running through a brief presentation, which will run for about 20 minutes. And in that, we're going to cover off the state of the insurance market, including some interesting insights into what's caused the recent upward pressure on insurance premiums. We're going to take a look at some of the fundamentals of the business continuity life cycle, as well as talk through some key, critical success factors in terms of preparing for your 2019 insurance renewal. Following that, we've left around 10 minutes for questions and answers. We find this to be probably the most engaging, obviously, part of the presentation. As we're going through, please do enter in your questions via the Q&A panel within the webinar. If you cannot see that panel, wave the mouse around a little bit, it will turn up and you're able to enter questions as we go along. So please do type them in. We'll attempt to address as many of those questions as we can possibly get to in that 10 minutes. Anything that we can't get to in that time, we'll look to take up with you offline directly. Great. Right, well, let's get started. Roger, we seem to have entered into a pretty interesting and hardening insurance cycle across a whole multitude of lines now. We're hearing premium increases when we talk to clients at anywhere between 20 and 30% up to 200%. And some clients are talking about being potentially uninsurable and certain perils being uninsurable. Can you tell us what is going on out there? And I guess some of the drivers behind what's happening in the insurance industry.
Yeah, certainly, Marcus. Thank you. I guess it does sound dire at the moment, and we are seeing a varied sort of renewal result for some of our clients, depending on what they do, how they do it, where they are, if you like, in the world, and that really comes back to the risk profile of the construction, the natural catastrophe exposures, etc., that our clients and prospects have. In terms of the slide itself, if you go back in time a little bit, it really all starts back at December 2017, which is the Harvey, Irma and Maria losses, which the hurricanes in the US that rolled through, the southern part of the US back in December 17 and took a lot of capital out of the markets, if you like, following those losses. Locally, then, if we go forward into January 2018, we had the Thomas Foods fire. And I guess from a food and beverage or, EPS exposed client perspective, that's really the turning point, I guess, locally and also internationally. And I'll get on to how that transpired in a moment. What, not necessarily a direct result, but a certainly large contributor to CG's withdrawal from ASX 250 clients in February 2018. They also changed their underwriting guidelines regarding the types of risks that they wanted to write going forward, which saw a withdrawal and or reduction in capacity and also a large sort of uplift in pricing for those more difficult risks. If you then move forward into the end of 2018, we had what is being termed a Decile 10 review. Essentially, for people who may not know how Lloyd's works, it's obviously a whole lot of syndicates, which is then run by a central board. That board dictates every year how much premium each syndicate can write. As a result of the losses in America and around the world, in 2017, the pre-tax loss for Lloyd's was in excess of £2 billion. They had a combined operating ratio of 114%, and their expense ratios internally continued to climb as well. So what they basically did was went to all the syndicates and required them to review their worst 10 performing portfolios and submit a business plan or a remediation plan to get them back to profitability. Those that couldn't do that or didn't do that were effectively shut down and or put into runoff. And where it really comes back into Australia in our context locally here is that the worst performing portfolios, if you like, out of the Lloyd's review were international property, US property, and overseas property in general. So what we saw as a result of the review is that property capacity in the Lloyd's market, which has traditionally been a little bit of a flight to quality. If things turn sour a bit here, people could always get capacity in London. We're finding at the moment that's not necessarily the case, particularly for the harder to place risks. So we have then, I guess, a situation where we have local markets withdrawing capacity. We have UK markets or Lloyd's markets also restricting or withdrawing their capacity, which is what's causing, I guess, the uptick in both price, the inability for some clients to get insurance in the first place. And that's sort of, I guess, in a nutshell, the genesis of where we are now.
So when we talk about property on that front, Roger, is that ISR is in property and associated business interruption, or is it purely just property?
It's both. So it's property and business interruption. I guess when I've been in London a couple of times this year already, and one of the things that's probably a little bit different from the past, if you like, is that the markets are really focusing in on that BI aspect of the risk. I think over time, obviously, Lloyd's is a mature market, as is the Australian market. But if you then go into the Asian markets, they don't necessarily historically insure business interruption, and are, as a result, slightly nervous about it. And also, it's one of those things that it's hard to quantify, and so it's relatively easy to understand the value of the building, how it's protected. It's less simple to understand how that's going to interact with a business interruption loss, particularly with relatively complex businesses.
Yeah. In terms of the market, I mean, what does that mean for pricing, capacity, retentions?
I guess, as you alluded to in the intro, prices are going up. There's, depending on your risk profile, and as I said, what your construction is, how you protect it, all those sort of things. As you said, they can be anything from the 15, 20, 30 up to hundreds of percents we've seen, to a level of uninsurability that we haven't seen probably since 2001, 2002. In terms of limits, we're seeing limits being reviewed. I guess in a softer market, we had a situation where the price of the capacity, if you like, was relatively cheap. And so, if you bought a $200 million or a $10 million limit, we just kept it at that level. We're seeing a lot more focus on the maximum foreseeable loss type scenarios, of which BI is a big part of that. Really reviewing whether or not those limits are required in order to potentially reduce the limit and save some money, and also get capacity. If you're going into the market looking for a $20 million limit, it's a lot easier to get that limit than it is a $50 million limit. So the focus around that is also increasing. Retentions are going up, particularly in specific areas. So, natural catastrophe, for example, if you're in a natural catastrophe exposed location, you can expect to see quite large increases in retention around wind, flood, etc. Likewise, coverage is also being put under scrutiny. It's a function, again, of a changing market, in that your sublimits are under review. All those throw-ins, if you like, that were able to be imposed on markets in the past are now coming under scrutiny, and I think it's more of a view of what's a must-have as opposed to a nice-to-have, and also whether or not the coverage is premium generating. So if it's something that will drive a premium, allocation from an insurer, then that's being scrutinised a lot more as well. Capacity, I think, as I mentioned before, in terms of the decile 10 review and then the ongoing impact of the market, capacity is reducing, particularly in those harder to place risks. I mean, I don't know if you've seen the news this morning, but there's another big fire down in Campbellfield. I think at a waste recycling facility. We had the one up in Warringah near Manly here a couple of weeks ago at a storage facility. So these sort of large losses are still continuing, which is focusing the market as well, which essentially leads me into my last one, is that the claims are still there, and we'll go from that.
That's perfect. That provides a lot of context, I guess, Simon. I mean, I know that we've had a lot of clients come to us more recently asking to get business continuity plans in place on the back of insurers stipulating it as a requirement for terms. There's I guess a mixture of people in the audience today. Perhaps you can just talk us through, what does business continuity look like? What does good look like? How can we get, how can we get up to speed for insurance renewal cycle?
And I think that's exactly it. Based on what Roger was saying, Marcus, it's how do you actually make yourself even insurable? And how can you put some procedures and steps in place to really market yourself back, not just through your broker, but ultimately to the underwriter there as well. To put the bottom line up front, what business continuity does and what it allows you to do, especially with good tailored plans, is turn the disruption of of kind of hours into minutes, days into hours, and ultimately from a business continuity perspective, weeks and months, reducing as well. So what I'd like to just walk through with you this morning, leading on from what Roger said, is what does an appropriate life cycle look like, and how does that actually link into your ability to communicate that back to the insurer? So the first step from here is that analyse phase. You can see some of the steps that are taken there, not just the policy and framework to make sure that it is leadership driven, which in terms of linking that back, it shows that the organisation as a whole is committed to the resilience of their organisation in a disruption. I would say in the analyse phase, what we definitely look at is making sure that any of your plans, any of your processes are actually fit for purpose. What we are definitely seeing is that when business continuity plans are analysed by an insurer, requested by an insurer, they're not looking for a box to be ticked anymore. They need to know that it is fit for purpose. It's specific to the risks of that organisation. So the analyse phase becomes really important, and a really important sell back to the broker or the insurer as well. If we then start to look at the plans themselves and what's required, we're talking not just about the initial incident response and the ability to stabilise and mitigate against what caused the disruption and the immediate ramifications of that disruption. Because when we're talking about about business continuity, we really are talking about the critical business functions, those systems, the infrastructure, and the people that are required to get your business back from the disruption to business as usual, or a state of business as usual that allows you to then kind of progress further. Now, when that is then communicated back through your broker or directly to the insurer, what we're then seeing is them being able to at least visualize what the post-disruption sequence looks like. And when you're able to say, well, we've put as much as we can in place to mitigate, it isn't about your risk assessment. This is about the threat and the disruptive, the threat and disruptive scenario that you're then mitigating against. If we go to the next phase of the business continuity life cycle, we're then looking at validation. Again, any of these plans, any of these policies are just pieces of paper until you start demonstrating them in practice. So what we've put up on the slide here is not just scenario exercising, which looks at these things being rehearsed and building that confidence and capability of your organisation, but we're also looking at the individuals that are involved. So awareness training across your organisation to build a resilience culture. So it's not just the leadership that's driving this, but you're seeing that individuals down at the front lines are really taking the business's resilience and their ability to respond to disruption as part of their day-to-day workload. And if you can communicate that back and start to demonstrate through training and exercising that you've got a culture of resilience, it makes you really attractive from there. And I think the last part of that validation is if you've actually got some really critical risks and you've got some really critical functions that insurers would be concerned about, you can also do very specific critical business function testing. Now, the difference between exercising and testing is a test is pass-fail. So you can, if you're passing that testing and you're proving those plans and you're able to do that in writing, that's a really powerful tool to communicate back saying, we actually have proven that we can do this. The last part of the life cycle is the maintenance. Probably the note that I would give you here, Marcus, is if I was to go into any business now and say, are you the same business that you were 12 months ago, 2 years ago, 5 years ago? I would find very, very few of our clients would ever agree that they are even a shadow of some of those businesses, especially with technological advancement and the application of technology into their businesses nowadays. So in terms of maintaining it, it is about reviewing it. It is about keeping it up to date. And it's also about providing that assurance statement to make sure that the subordinate elements of your organisation are maintaining their parts of the plans as well. So again, it is about making yourself not just resilient, but being able to demonstrate that back to the insurer through your broker if required, and actually bringing them along for the ride, because all of a sudden the conversation in the renewal is more about the core things that you need to insure, not about whether or not you're ready for it.
Yeah, no, that's good. Thanks, Simon. Roger, how many trips to London have you done the last 12 months?
Last 12 months, unfortunately, I've been there twice in the last 2 months.
Got it. So, thinking, and the reason I ask, I mean, you're obviously in front of insurers and underwriters a lot. Learning what we've learned over the last 12 months, I mean, what are the key takeaways here? What's the things we need to be taking into account as we walk into insurance renewal cycle to get the best outcomes possible?
Look, I think early access to the market is critical. And I say that because as a result of these reviews, etc., the old terminology, I guess, in our world is that the pen has sort of been taken away from the line underwriter a little bit. So there's a lot of internal sign-off being required. So, they review it, it gets referred internally, and there's a lot of sort of actuarial work being done in the background, risk modelling, all those sort of things. So it's definitely about starting the process early, getting your submissions in early, giving the market the time and space to actually do the work they need, which will help them, I guess, get their stories and get their sign-offs done across the line. I think in conjunction with that, detailed data is really the key. And we say that, I think the days of just, putting in your risk report with a slip are gone. You need to, they need to understand where you're up to on your risk management journey. You mentioned being in London. Most of the questions that we received in Singapore and London were all about, what's your BCP like? What's your crisis management plan? They understand, as I said at the open, that buildings are worth a certain amount of value and how they're protected. What they don't understand is how you're going to respond in the event of a loss, which is really where your stuff comes into that in a big way, in an increasingly sort of interested market, saying, we really need to understand that aspect of your business. And that really leads on to the last piece, which is, you try and differentiate yourself from your peers. If you have EPS or if you have, a difficult to place risk, it's how do you act differently to Thomas Foods or to your other peers that have had these fires. And that really comes down to, a lot of the underwriters still understand you're not going to retrofit sprinklers into all your facilities and all those sort of things. It comes down to that human element aspect, the cultural resilience that Simon mentioned, how you're really going to respond in the event of an issue. So that ability to differentiate yourselves and have a plan, have practiced a plan. It's not just a manual in the bottom of a drawer anymore. You've got to really understand what you're doing. So that's really, I guess, the key aspects to preparing for the renewal that we, in a nutshell.
Perfect. Simon, thoughts from your side?
Roger seemed to articulate fairly well, which was really nice to show that it is about that additional commitment, not just the differentiation, but business continuity is no longer a box ticking exercise. From our perspective, we've never done that. And any time that we face a problem that we need to get something out of the way, the value set of business continuity is in the detail, it is in the data, and it is about making a plan that actually works when the disruption occurs. For you to be able to take this to renewal, you have to show that commitment across not just the leadership, but all the way going down through in terms of the training, the exercising. And as Roger was saying, it's your people that are going to drive this anyway. And then ultimately, when you get to the renewal, it is about being able to show that evidence. So one of the things that we've seen out of some significant disruptions and some tragic events recently, even go back to something like Dreamworld, where they could not demonstrate even the basic training at a safety level, let alone their ability to recover their critical business functions and some of their processes, because they weren't recording a lot of the notes and a lot of the training evaluation guidelines, forms about who was attending. So it's about presenting that evidence and recording that evidence as well, Marcus.
Yeah, no, that's perfect. Excellent. Well, that, gents, thanks very much for that. That, I guess, concludes the content part of the session. We're going to move into questions and answers. If you haven't typed in any question, you do have a burning question, please do wave the mouse around, drop your question into the Q&A panel, and we'll start getting through these as soon as possible. I have a few here. Dean, I'll start with this one. This is going to be interesting. I might throw it to both of you. D&O insurance has seen massive premium increases. Is business continuity planning relevant to underwriters in this risk also? Roger, I might start with you.
Yeah, I'll take that. I guess there's a few elements to directors and officers insurance. One of the, I guess, most publicised pieces, the class action environment, etc., which depending on what type of I guess incident or exposure leads to the class action, definitely falls into the BCP arena. So a lot of the in the crisis management phase of it as well, in that some of them are as a result of workplace injuries. We saw the scaffolding collapse the other day out in Western Sydney. So what sort of safety mechanisms are in place, all those sort of internal I guess processes that can lead up to an external party coming after an individual director. So BCP definitely has probably more so crisis management has a role to play in that.
Yep. And I would definitely agree with the crisis management aspect of that response that Roger was talking about. The business continuity part about that, it is still relevant for underwriters of the risk, because what we're also thinking there is about loss of key personnel and being able to work through and what that looks like, the targeting of those individuals. And because if there is an issue there, it's being able to show that there's some resilience within that particular area. But the crisis management part, being able to clearly show that leadership is committed to communicating, being open and transparent through a particularly disruptive event, actually gives them ammunition to be able to, or direction to be able to respond effectively.
No, that's perfect. Excellent. Would you advocate that brokers get involved in scenario testing of their clients? Simon?
Absolutely. If you, especially coming up, I wouldn't even say coming up to a renewal. The reason why I would say absolutely is you're the client advocate. The more that you get to understand how your client would respond in a disruption is going to allow you to have that conversation quickly, easily, and really get to know the ins and outs. From a business continuity perspective, purely as an academic process, we get to know about what is critical to those clients, but not just those top 5. We're talking about processes that go beyond that first day. The insight that you're able to then glean from this type of process, as I said, purely academically is phenomenal. So for you as a broker, being able to understand that, but also the response to that, would be absolutely key. From a client's perspective, having the broker in the room is, again, arming your advocate with information to be able to allow them to move forward on your behalf in order to go into that renewal as a champion of your organisation.
Yeah, no, that's good. Roger, anything to add?
No, I would totally agree with Simon's comments. I guess, as he said, it's about, from our perspective, it's not a transactional process really anymore. The market is getting more difficult, and the more you understand your client's risks specifically, the more you can answer that risk question to the market, and being alongside your client and seeing how they respond, gives a lot of weight to that discussion with insurers.
Yeah, excellent. Okay, this is interesting. It's probably more of a Roger question. How long are these market conditions going to last?
No, that's a very, I won't say how long is a piece of string. So, look, without obviously having a crystal ball, I think, we're at least another 1 to 2 years of the cycle to continue. I think one of the market is cyclical, as everyone probably knows. I think we've had the benefit of a longer downturn than we have upturn. However, we get to a price point where the price looks attractive to markets to provide capacity again. So I think ultimately we'll get to a point where capacity will be attracted back into the market because there is a price point which can sustain that capacity, and then the cycle begins again as more capacity comes in. There's more activity to attract clients, and the cycle continues. So in terms of length of time, once again, no expert, but my feel for it is it'll be another at least 18 to 24 months before we sort of see a significant alteration to the pricing.
Perfect. Simon, this is probably for you. Is it business continuity plans or crisis management plans that we need?
Both is the short answer. So they deal with very different things. Crisis management is about the strategic position of your organisation. And it is about managing a disruption in terms of your objectives, your reputation, and that strategic market position. It's about stabilising the event to make sure it doesn't get any worse and coming out of the event in a better position strategically. Business continuity is about the recovery of critical business functions. It is absolutely about what you do as an organisation and how you move from disruption back to business as usual. So the clear answer to that, Marcus, is you actually need both.
Yeah, that's good. This one's interesting. Is there any value to sticking with a particular broker or insurer, or should I just shop around every year for insurance? Roger, that's definitely for you.
Well, from a broker's perspective, if you're not with Aon, it's definitely worth shopping around. Look, I think it's probably, understanding that if your broker has the right team to represent your interests, as Simon said earlier, around how they go about the job, how they engage with the market, how they engage with you, and the strategies they put in place to get you the best deal at a challenging time. I think from a market perspective, it's also an interesting question in that everyone always talks about tripartite relationships, long-term relationships, et cetera, and then you see markets drop out and leave you in a bit of a lurch, which can be challenging. But what I would say is that the likes of a London market are very attuned to whether or not you're a current buyer in the London market or not, and that definitely influences their pricing decision. If you are in there, I guess as a distressed client, if you like, they make no apology for telling you they'll be opportunistic in their pricing, because they understand that in a couple of years' time, when the market does drop off again, you'll jump back out. So whereas where we have clients who've been in the London market and or Australian and or Asian markets for a period of time, their renewal, whilst it still goes up, is actually treated more favourably.
Yeah, no, that's good. We're almost out of time. I'm going to do one last one because I just saw this and it's quite a good question. It's probably one I'll throw to Simon. What advice would you give when board/management don't have any interest in business continuity or crisis management? How do you get them to pay attention to the importance of plans?
I think there's plenty of evidence nowadays, especially around crisis management, of boards and executive leaders within or management within an organisation that didn't have a plan and tried to wing a response and got it horribly wrong. I think that's probably the first way to get their attention is to demonstrate through case study of where a board or an executive team wasn't prepared and they're either exposed as such in the media or in subsequent investigations. It's come out that they've, like, the perception of that organisation has decreased. I think the other thing to think about there specifically is when we're talking about costs, there's from a business continuity perspective, when you actually start to do some of the investigations of some of the disruptions and the time, and you can very quickly start to observe that the timeline around there, like, compared to what everybody else thought reasonable, had stretched out considerably longer because they were trying to find a way to recover. And remember, that's what business continuity is about, is recovering quickly from that disruption. So case studies is the easiest way to get them to pay attention. But the importance of these plans, it just cannot be understated in terms of how seriously do you actually want to take your resilience in an organisation. If you actually, I think one of the questions that comes up more often than not is the reason that they don't find the importance of these plans is because they don't understand it. And all it takes is one of those case studies to say, hey, how would we respond to this in that conversation? And you start seeing people get very nervous.
It's really, really on point there, Simon. Thank you very much. Gentlemen, I am going to call a close to Q&A. We are running over, so I do want to thank everyone for your questions. There's still quite a few there that we haven't been able to get to. We will take them offline and come back to you directly. If you have entered as anonymous, please do send me a quick email. My contact details are there. Following this, what we will be doing is sending around a feedback form. Feedback's a gift. We would love your feedback to make these sessions more valuable and on point for yourselves. So please do provide feedback where possible. If you need any assistance, obviously, from a resilience or insurance renewal perspective, our contact details are available there, and we'd be happy to pick up any questions offline. But more than anything, gentlemen, thank you very much for your time.
Thanks, Marcus.
Thank you. Enjoy your weekend.
And thank you very much for joining us today. We hope you have a great day, and we look forward to another session with you shortly. Cheers.